When should you use a whole life insurance policy loan instead of utilizing a bank? Well, if you listen to the infinite banking world, they would tell you that you should never use a bank loan. You should always use your policy loan. In fact, the purpose of the infinite banking concept is to take control of the banking function of your life and eliminate the need for banks. In this video, I actually had Caleb Williams from Better Wealth over at my house, good buddy of mine, and he was in town and came over one night, and it was like 9:30 at night, and we decided to have some fun and film a video and get into infinite banking, and if infinite banking or not even infinite banking, just using policy loans really makes all the sense in the world, and what is the framework that we should use. He shares his framework. We had some really good conversations, and so I think this is going to be a big value add to you. We ended up breaking this into a two-part video because the conversation expanded so much, so I'm really excited to get you into this. If you're an agent, I think this is going to add a lot of value into the way that you communicate and share and understand the use of policy loans. And if you're a client that's looking to do this for yourself, I think this is going to help answer a lot of questions that you probably have about a lot of the confusion about, does it make sense to use policy loans? Why would I take a loan against my money to make money and all these different things? And I think we're going to be able to clear some of that up for you. But if you have any questions along the way, make sure you comment in the comment section below. I'll do my best to answer every question that I possibly can. And that's it. Until next video, have a blessed, inspirational day. But here we go. Let's get into this.
All right, guys. This is part 2 of a video of Chris and I just going crazy on the vibe board. We're talking all about infinite banking, when you should borrow against your policy. There's so many things that we could talk about, and you mentioned something that I'm like, man, this is amazing, and we probably should just make another video about this.
So here we go.
Infinite banking doesn't give you arbitrage.
Right.
I know that might shock, like, you do not get arbitrage when you borrow against your policy. I'm going to share with you later in this video why I think that's okay and like why I don't freak out about that.
Right.
But you mentioned something about there are people out there that say you can borrow against your policy at 5% and your dividend 6%. You're making more money. Like, I've seen this multiple times. I've seen people I highly respect that don't have YouTube, don't have TikTok, that are misrepresenting these things.
Yep.
I hear clients saying, well, my dividend is this, and it makes me so frustrated because whether we know it or not, we're misleading people when we say the dividend is going to get paid this, and you're borrowing at this, you're arbitraging your policy. So without further ado, let's blow that thing up.
And with that said, I also want to say this. If you buy the story that infinite banking is about positive arbitrage, this is why you have all these idiot IUL agents out there trying to convince people that that IUL is a better policy for infinite banking because of the potential to get positive arbitrage inside of an IUL, which is a whole different conversation. But
subscribe to Life 180 for that.
But like that's a big thing. So here's the thing. When you look at a whole life policy, so what we have here is, whole life with a participating mutual company. What you have is you'll have the dividend will be, let's just call it 6%, right? So you have a gross dividend. I'll just say gross, right? So if the gross dividend, let's call it 6%. So then what happens is they're basically saying, all right, we're doing this gross 6% dividend, but then you have to minus out all sorts of all the mortality charges, expenses, and basically everything it takes to run the life insurance company. Okay. So when the thing to know, the beautiful part about having a policy with a properly designed policy with a participating mutually held company, and I guess I'll just do participating. The purpose of the participating is you are participating in the profitability with that company, which is magic if you think about it. Like, I always kind of tell people, life insurance companies, when you put your money in a properly designed, participating mutually held company, you basically are giving your money to the most stable financial companies in the world that have 180 years of success across the board from an industry perspective. Some are, I would say don't go with a company that doesn't have at least 100 years of doing this successfully. You have the ability to have them manage the risk of your money, get you what life insurance companies do is not sexy. It's not designed to get you wealthy. It's not designed to get you massive returns, right? And that's the problem with IUL. Everybody's trying to position it like life insurance. All of a sudden, after 180 years, got really good at getting these massive returns. Like, you know, it doesn't work that way. They are focused on getting you the best possible return with the least amount of risk. That's it. But when you throw that last part in there, that least amount of risk, it takes a lot of the upside away, right? But if you look at what whole life will do, it'll get you bond-like returns, muni-like tax treatment, money market-like, you know, liquidity, which is great, but it's not sexy. Let's face it, bond-like returns are not super attractive. But when we talk about, you know, the fact that you're minusing out these mortality charges and expenses, this 6% rate is not actually 6%. That's not what's credited, because you got to take this out. So what I always kind of like look to do is from a long-term perspective, because especially early in a policy, your expenses in your policy are going to be much higher.
Right.
As the policy matures, the policy is going to be great. Like, I mean, you can start, and just look at an illustration that's designed properly. You can look, you know, year one, if we look at like premium, let's say premium, cash value, and then death benefit, right? So if we do this and we say, all right, the premium's 10,000, right? Cash value, let's say it's 6,400, right? And then, or let's just say 6,000, 60-40 policy, right? And the death benefit, let's just call it 250,000, right? So what's happening here is that we put 10,000 in, right? If we borrow from this 6,000 right away, you know, let's say we borrow 5,000 of that, $6,000, because for some, we want to take a vacation, right? Like going back to the last video, we want to run our vacation through our policy, like some of these guys would say to do. You know, so if you do that, now you're borrowing, you know, we're taking a loan of 5,000 and we're paying 6% on this, let's just say, right? According to the numbers in the last video, I think. So we're paying 6% on this, so, you know, that is what it is. But the cash value, now that our collateral capacity goes down to 1,000, right? Which is important to understand. But this, even in a non-direct recognition company, we're not earning
6%.
We're not earning that money. We're earning much less, because and plus we've given up control of the $4,000. Right? Like so this is absolutely a long-term strategy, and for every dollar that we put in, we're negative out of the gate. We have a capitalization period, right? But if we go down the line and we're 10 years down the line and we've put in $10,000, my guess is at the end of the day, from a cash value perspective, year 10, assuming that we didn't take any loan, any loan yet, we've just let it kind of grow and do its thing, and the magic has happened. Maybe you have like, I don't know, 110,000, something like that, maybe a little more, whatever. But let's just call it that. The death benefit's probably grown to like 370,000 with paid up additions. And so now we're in a position where every $10,000 for like year 11, we put in year 11, now it's going to grow by more, right? So we can look at the actual rate of growth of the policy is probably going to be 4.5 to 5, 6%. You know,
well, no. If you take an internal rate of return, you're going to get anywhere from, it's going to be around 2%. But like, we want to talk about IRR.
Right. We're talking like, I'm talking year over year. Now.
Okay. Annual.
Right. Annual. Year over year. Because for the internal rate of return over that period of time, you're looking at 2% from now. When you get to year 2025, you could be in the 4.5% range. Which if you're looking from a long-term perspective, that's great. That's, that's bond, comparable. And the taxable, equivalent return of that, it's decent, right? But if we're looking at this and we could say, hey, let's just say, you know what, just to keep it simple, let's just say we did a 10 pay, right? Just to say, all right.
And just out of curiosity, are they just seeing the board, or are they?
Yeah, they're just seeing the board.
Okay.
They're just seeing the board.
Okay, cool.
So if they're doing a 10 pay, and this is year 10, they've paid it up, they have this, and there's no more money. This policy is paid up. Okay. And so now there's no more premium going in, and let's say this 110,000 grows to 114 and change, right? So like, that's like not a bad internal rate for that year, annualized rate of return, but it's still not the 6%.
Right.
You know what I mean? And so like anytime you're borrowing, you have to understand, like all these people are like, you're paying yourself interest. No, you're not. Like you're paying the insurance company interest. You're paying them 6%. You're earning let's just call it 4.5%. So you have a negative arbitrage.
Yep.
Let's just say that you're, like a lot of the infinite banking people will say you're paying 5% and you're earning 5.2, right? Because that was what with one of the bigger companies that is big in the infinite banking space, that was their declared dividend. And so they'd be like, and this was what it was. You could borrow at 5 and you could have a 5.2% dividend.
Yeah.
The 5.2 is not what you were earning. You were earning this. So there was never arbitrage, even in an environment where it looked like there was, and it's a smoke and mirrors game. It's a misrepresentation about how it actually works. Now, you and I both still agree this is awesome.
Right.
I mean, it's not awesome to take it. It's awesome in the fact that you have this account that's going to do these things.
So let me redraw this in the way that, because I want to set the stage, and then we can change camera angles and talk through this. Okay, so let's just say your policy long term is going to grow at 4.5%. I look at IRR, and so what IRR is just internal rate of return. Over a long period of time, in the early years, you're going to be negative IRR, usually around 4, 5, 6, 7 years. It's going to break even, and then longer time, it's essentially saying the money that you put into this policy, if you were to put it into the same savings account that was tax-free, that had all the same benefits of life insurance, it would have to earn 4.5% every single year just to give you the same return. So like we can agree 30 years from now, like your money is earning 4.5%. It's also tax advantage. There's other things that I could make the argument. I could make the argument over here to say, well, that 4.5% is actually like a 7 because of the tax benefits and the term insurance that you don't have to buy, because there's other benefits here. But I'm not even so let's just say that you're earning a true 4.5%. So now over here, let's say if you want to take a loan, it's going to cost you 6.5%. So what I would say to this is like right here, there's no arbitrage that's happening here.
Right.
No arbitrage at all. And so if all we cared about was arbitrage, this would not make sense. So my question is, and this is what I think we need to talk about, is why am I drawing this out and saying I am okay with putting money into life insurance, knowing that I'm not going to have arbitrage, knowing that it's going to cost me maybe more than I'll ever make internally in my policy? And my answer to that is we have to understand that there's way more benefits to life insurance than just the rate of return. If all life insurance was an asset that was kicking out an internal rate of return and it gave me no other benefits, I would not do this.
Right.
Like there's probably better ways for me to do this. Like the rate of return is better than other accounts, but at the end of the day, like why would I do that? I do that because life insurance has a death benefit. Life insurance has other chronic illness riders. Life insurance is a tax-free asset when set up and used properly. Life insurance is going to give me the stability of lifetime growth, whereas other assets are going to have volatility. Life insurance has so many other benefits, and so when I start adding up the benefits, I start getting to a number personally, and this is not personally, when you start adding up the benefits, I think you can make the argument that life insurance gets you around 14 or plus rate of return, 20% rate of return, when you start adding the benefits of the value of control, the value of it being privatized, the value of creditor protection, the value of death benefit, the value, you share the story of like chronic illness riders, of like the ability to pay down the death benefit that could potentially save someone's life. You have a personal story about that. Like, what's the value of all that? I value that much higher, but I can say that in the same breath of saying, I'm not telling you life insurance is getting you 14 or 20% rate of return. I'm saying because I understand all the benefits that it gives me, I put a value on that. That's why I'm okay borrowing against it and not arbitraging, because at the end of the day, over here, I'm going to earn far greater than whatever I'm borrowing. And so this is just the cost of control, but I'm getting all the benefits of the life insurance.
I'll take it a step further.
Yeah.
So when you're talking about this is an internal rate of return over, let's just say 20 years.
Yeah.
Right? And that means if, year 1 through 5 are negative and year 6 is break even, that means from year 7 and beyond, the policy's doing way better than 4.5 on average because it's catching up for the first 5 years being
But
negative.
I think IRR is the most
I don't disagree.
thing
I don't
to-
disagree
okay.
with you. I'm
Yep.
setting the stage.
Yep.
Okay. So 20 years in, that's meaning, I'm just making sure everybody's
Yep.
really clear on what this means. It means if you have an IRR 4.5% by year 20, right, with this 4.5% here, that means if you put $10,000 a year in, it's assuming
Yep.
that you, on average, you would have had every single year 4.5%.
yes.
Like, it's not assuming you had negative the first year. It's like it's catching up for even incling the negative years.
100%.
Right?
It's assuming every
So I
single
just
year.
want to make sure that's really clear.
Yeah.
So what does that mean? That does mean, and this is where infinite bankers are not necessarily lying, but they're also not telling the truth, and they misrepresent how this actually can work, right? So, well, and here's the thing. So, like, if we know years 1 through 5 are negative, right? Negative on the internal negative IRR, and years 6 through 10 are going to be like 0 to 3% or something like that, depending on how it's designed. You know, then years 11 through 20 will be probably like 4 to 5%. You know, or maybe even a little better than that, like 4 to 6% annually, right? And it can be better. And listen, guys, this all varies based on the current interest rate environment, like the current bond market, like all these different things. And so there are situations where, we could have it. So if the policy is mature enough, right? Let's say it's year 15 in the policy, and the policy is getting an internal rate of return at 6%, and then the market, because interest rates have come back down or something of that nature, that the loan rate goes down to 4.5%. I'm not saying there's not a world where you could not find positive arbitrage inside of a whole life policy, right? And this is the problem. And I'm only going here because I think it's really important to understand that it's not that infinite banking people are lying to you, because it's possible.
Right.
It's not the rule. And it's not what you should rely on, and it's not why you should do it.
Right. My problem is they should look at the IRR. They're taking the dividend, and they're saying the dividend 6%, but it's like, let's be honest, you're not getting paid. No one's paying you 6%.
But what I'm saying is the IRR doesn't matter when you're looking at it. It matters from a long-term perspective, and that's a beautiful thing, because it matters from the perspective of like, all right, so I did a video talking about how whole life helps and it grows with you. It's the only asset in the world that will grow with you in every phase of life, right? So like think about it this way. When you're 20s, right? What do you need in your 20s? You need to start saving money, right? And maybe when you're in your mid to late 20s, you start having kids. So like late 20s, 20s to 30s, you start needing life insurance, right? And then maybe after that, you start, wanting to borrow against it in your 40s for like college, for kids, other elements of that nature. 50s, you might start needing the chronic illness.
Let's hope not.
Yeah. It's America.
Yeah.
Like, hopefully not, but this is where things happen, even for people that are healthy. Like, this is where sometimes, unfortunately, health starts to wane on a portion of America or the world, right? Human beings. At 60s, now you have a volatility buffer. Right? So the internal rate of return has an impact of 4.5% here, right? This has an impact when you start talking about this, right? And so that's the number that really matters when we're comparing it like that from a long-term perspective. But when we're talking about it from a loan perspective, we have to look at it, when are we taking the loan? At what chapter of the policy is that loan being taken? And the reality is, most people that are getting these policies are like, I want access to my money right away. Right? And that's the danger. Like, I feel like the worst part about this is like the infinite banking people out there, not all of them, but many of them are taking it and they're selling like, hey, fund your policy, take loans at it, and they talk to people like they're gonna get the benefits like the policy's 15 years old, but they're not.
Yeah, and yes, and
Right?
But the reason it's okay to take a loan even early on is you get that asset will give you the future benefit.
100%. You're never going to interrupt this internal rate of return, which is a beautiful thing.
But the point that I want to make is if there's other benefits to life insurance, like we have to value more life insurance more than just rate of return in the arbitrage.
100%.
Because yes, is this true? Could we have arbitrage in the future? Yes. I never want to sell someone off of that because life insurance is valuable even if you don't have arbitrage.
Of course.
And so yeah,
because the only other thing is, and what Caleb is saying, I think is like for me, the LBRs, living benefit riders, right? Like that's a thing, right? So the chronic.
But it's just like the fact that you could potentially get a higher income distribution at age 60 because you have life insurance versus a bond is like, how do you put the value on that kind of deal?
Yeah, I mean, it's going to get you bond-like returns with a lower standard deviation.
Yeah.
You know, I mean, like that's amazing, especially looking at what the bond market just did, right? But the fact, I mean, and I also look at it like there's ways that you can't even calculate, right? Because here's the deal. We live in a world where people are crunched for cash, right? And so we always say it's a great tool because it gets each dollar to perform multiple functions, right? And a lot of times people are like, what the hell does that even mean, right? And so the fact is, these living benefits can function and help. It's not necessarily always a replacement, but it's a great alternative if you don't have for like long-term care, for disability, for, you know, if you lose 2 of 6 daily living activities, you become cognitively impaired. If you get diagnosed with a cancer, with a terminal diagnosis, you get access to your death benefit while you're alive that will give you these benefits. These insurances all have a cost. And the reality is, you're 70% more likely to need to use long-term care or get some sort of assisted living or need to use this benefit before you die than the actual life insurance. So why do we only talk about the life insurance when you're 70% more likely to need to use a living benefit, right? And if you don't have a living benefit, it's going to decimate your retirement account. And so these living benefits have costs, and if you haven't looked it up, go look at the cost of long-term care insurance. And that cost alone, the rate of return, the internal rate of return bump that you would see if you just said, all right, cash flow wise, how much is it saving me on my premium costs that I'm not spending because I've got this asset that's backing me up. It's a backstop to my wealth preservation, to everything I've done.
It's good.
It's amazing.
It's good.
You know what I mean? You can't calculate that return. And the people that don't understand it just infuriate me.
So I think how do we land the plane here? Because I think I love doing videos with you, but we go all over the place.
I know.
So I think the point that I want to make, and you can have the final word here, is in infinite banking, you do not get arbitrage. Simply saying long term, if it gets you 4 or 5%, I would not put money into life insurance because I think I'm in a year 20, I'm going to make more money in my policy than the cost it's going to cost me. And that's okay because of all the other benefits that a multidimensional asset gives me for when it looks at retirement, when it looks at protection, when it looks at the living benefit riders, all those compound and I say I value life insurance far greater than the cost that I have to use or like the lack of arbitrage that I get. It's actually, I don't care that I don't get that arbitrage because I actually do arbitrage when I value all the other benefits. That's the point that I'm trying to make is I'm trying to on one hand say you don't arbitrage with your IBC policy or whole life, and number 2 is that's okay because you should understand that life insurance has far more benefits than just the rate of return.
Yeah, I would say, I guess how I would end it for me is just looking at it is we have to think holistically about everything, about all our needs, about why my vibe board is freaking out. We have to think holistically about all this stuff. And if you're thinking holistically, I'll say, and the challenge with infinite banking is that they try to eliminate the holistic conversation. In a lot of situations. I'm not saying they always do that, but in a lot of situations, they try to eliminate that holistic conversation. I think both Caleb and I agree that you should have many assets, many streams of cash flow, many ways to do that. And that whole life insurance is not an investment. It simply will help your other investments be better because of all the things that we just talked about. And so you know, when you start to realize that and see the value, I think once you start to have clarity about what you're trying to accomplish and where your risks are, and trying to take risk off the table as much as possible, you start to realize is you're not able to have an optimized strategy without whole life being part of it.
Yep.
I think that's really what it comes down to.
Yep.
Right. So
I love it.
that's it.
Thanks, guys.